Welcome back everyone, I hope you're doing well, and in this video, we're going to go over 6 stocks to keep on your watch list for the upcoming trading week. This is a recurring series on the channel where every single Sunday, we go over the major events coming up over the next few days and the stocks that may be impacted. And coming over this next week, we have some major earnings reports from some of the best dividend paying companies on the market. So any results that could lead to share price volatility may create some excellent buying opportunities for some passive income stocks. And for each of the companies we're going over, we're going to take a look at their current financial position, the company's current dividend info, and the future expected earnings over this upcoming week. And before we do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and the first stock we're going to take a look at in this Sunday's episode is ticker PG, Procter Gamble. The company currently trades for $137 per share and is up over 12% on the 1-year chart. They have a market cap at $338 billion and a current dividend yield of 2.3%. And Procter Gamble is the leader of the consumer sector, and they own 65 different brands that sell products across 10 different consumer categories. And why I love this company so much is because they sell pure necessities. No matter what's going on in the economy, consumers are always going to have a need for Procter & Gamble products, and sales will consistently come in and grow every single year. And throughout the first half of their 2021 fiscal year, all 10 of their product categories have seen positive organic sales growth, with the 3 leaders in the home care, family care, and oral care sectors growing by double digits. And going forward, this company is projected to continue to grow, and for their latest earnings, which are coming out on April 20th, we have a revenue estimate right around $18 billion and earnings per share of $1.19. And we can see over the past 4 quarters, the company has beaten analyst expectations each and every time. And going forward throughout 2021 and into their 2022 fiscal year, we're expecting some slight growth in their EPS every single quarter. And Procter & Gamble has one of the longest active dividend growth streaks on the market, and this company has just announced another 10% raise to their annual dividend payment. So throughout a global pandemic, not only are they paying out that cash flow, but they actually raised it by 10% over their latest report. And we can see their dividend info. They have a current yield of 2.3%. They're only paying out around 55% of their net income, which is very low and very sustainable. And they've been raising that payment, averaging around 3.6% every single year. And their current streak is at 64 straight years, which is incredibly impressive. This is a dividend king, and they've proven through good or bad times in the economy, not only will their products continue to sell, but they'll be able to raise that dividend to their shareholders every single year. So Procter & Gamble, one of the strongest dividend companies on the market, is definitely worth taking a look at as the company reports their latest quarterly earnings over this upcoming week. And now if we move on straight into the second dividend company in this video, we have ticker VZ, which of course is Verizon. They currently trade for $58 per share, and over the past 12 months, the company's up a mere 1%. They have a market cap at $241 billion and a very high dividend yield of 4.3%. And with the market continuing to trend to new all-time highs, it's getting harder and harder to find solid companies with nice high dividends, but Verizon continues to pay out an over 4% current yield. And the company currently trades with a forward PE of only 11.5, so a lot of value coming from Verizon at this current share price. And if we move on to their investor presentation, they're expecting continuous growth through the expansion of 5G and their recent acquisitions, which are going to bring Verizon services to a new market. And throughout 2020, when a lot of companies were hurting for cash flow, this company actually saw a major increase to over $23.6 billion of total free cash flow in the full fiscal year. So they have a lot of capital to reinvest, grow the business, pay down debt, and continue to dish out that capital to their investors in the form of a dividend every single quarter. And the company is sharing their latest quarterly results on April 21st before market open. We have a revenue estimate of $32.5 billion with earnings per share of $1.29. And over the past year, they have beaten on EPS expectations every single quarter, and we're expecting a slight expansion over this next report. And if we take a look at their dividend scorecard, this high-yielding company currently pays out 4.3%. Their payout ratio is still very sustainable, making up only half of their total net income, and they're growing it at a slight rate just above 2% every single year. So if you're looking for a high-yielding company, you want some growing passive income, Verizon is definitely a name to take a look at for the expansion of 5G going forward, and Buffett actually picked up more than $6 billion of Verizon stock over the past few months. So he definitely sees some upside in this company going forward over the next few years. And now if we continue on and jump straight in to the third name in this video, we have ticker J&J, which of course is Johnson & Johnson. The big healthcare giant, the dividend king, they currently trade for $162 per share, and the company is up 8.4% over the last 12 months. They have a market cap at $427 billion and are trading with a forward PE of only 17 and a 2.5% current dividend yield. And this company is one of the top names in the healthcare sector. They generated over $82 billion of sales in 2020 across their three main business categories, which include the consumer health products like Tylenol, Listerine, and Band-Aid, their big pharma sales, which made up around $45 billion, and of course the medical devices, which came in with $23 billion of total revenue. And Johnson & Johnson is another company similar to Procter Gamble that is nicely diversified and has many different brands making up their total revenue. And we can see 28 of their different platforms/products each generated over $1 billion in annual sales. So they're not solely reliant on one or two main goods to drive their total growth. Rather, they're nicely diversified with a wide product mix, and if one or two of their products does go down, the entire company's sales will not be harshly impacted. They own 16 different brands that generated over $1 billion of total revenue and 12 that crossed $2 billion in 2020. And they're sharing their latest earnings before market open on April 20th. We have a revenue estimate of over $22 billion and earnings per share of $2.35. And over the past 4 quarters, they've beaten on EPS expectations each and every time as well. And going forward, through the late quarters of 2021, we're expecting some nice high double-digit earnings growth every single quarter. So definitely another company to keep your eye on, and they currently offer their shareholders a 2.5% dividend yield. They pay out a very low and sustainable 42% of their earnings, and they grow it averaging 6% every single year, and they've been doing this for 58 consecutive years, which is extremely impressive. This is a company I own in my personal portfolio, and if we see any dips over this upcoming week caused by their latest earnings, I will definitely be buying more. I believe in this company long term. I think they're going to continue to slowly grow and return capital to their investors every single year. And now if we move on into stock number 4 in this Sunday's episode, we have ticker KO, which of course is Coca-Cola. The company currently trades for $53 per share, and over the past 12 months, they are up by 14%. They are trading with a market cap at $231 billion and a current dividend yield of 3.13%. And I'm sure everyone knows this company, and I'm sure we've all consumed their products at some point in our lives. They have been operational for 133 years, and the company sells products in over 200 countries and territories all across the globe, and they currently own over 500 different beverage brands. And we can see their product volume is sold evenly all around the world. 20% from North America, 30% from Europe, Middle East, and Africa, 23% from Asia, and the remaining 27% from Latin America. So we can see in this company, they're not solely reliant on one part of the world for a majority of their volume. Rather, their sales are evenly spread out across every different continent, which is extremely impressive. And going forward, even after they already dominate the global beverage market, they're still projecting organic revenue growth, EPS growth, and free cash flow to come in at over $8.5 billion. So this big dividend giant is still slowly growing every single year. And we can see they're sharing their latest earnings before market open on April 19th. We have a revenue estimate of 8.63 billion and EPS of 50 cents. And over the past 4 quarters, they have beaten EPS expectations every single time. Analysts are expecting a slight 1.5% decline in year-over-year earnings, but going forward, in the quarter after that, we're projecting a 32% expansion, which would be absolutely incredible. And they currently offer their shareholders a 3.13% dividend yield. If you buy the company at this current share price, they're paying out around 78% of their net income, and they've been growing that annual payment at 4% over the past 5 years, with a current dividend growth streak of 58 straight years, which once again is extremely impressive. So over this upcoming week, we're getting the latest quarterly results from some of the biggest dividend kings on the market. We've already gone through Procter Gamble, Johnson & Johnson, and now CocaCola. Over the next few days, if you want to pick up some very resilient dividend-paying companies, these 3 dividend kings may be trading at attractive levels. And now if we continue on into stock number 5, this is the only growth company included in this week's episode, and this is ticker NFLX, which of course is Netflix. They do not pay out a dividend, and this is purely a growth company with a current share price of $546, and they have grown by 24% over the latest 12 months. They have a market cap at $242 billion, and we all know this company for being the leader in the streaming sector. And I think going forward, even though Disney is going to compete, and same with HBO Max, I don't see any other brand knocking Netflix out of the top 3 position in the streaming sector for decades to come. They've done a terrific job of focusing on new innovations, using AI to get consumers staying on their platform, and coming out with new content every single week. And throughout 2021, they've announced that they're releasing a new movie every single week of this entire year. So no matter what, as a Netflix subscriber, you're always coming back to see what's new. And their new shows are taking off like crazy. Netflix originals are getting more and more popular, and I think this brand will be a long-term success in the entertainment space. And the company shares some great financial news as well, that by year end 2021, they expect to be cash flow positive, which would be absolutely incredible. And after they can grow their positive cash flow, they do plan to do share buybacks to return some excess capital back to their long-term investors. And this next quarterly report, which comes out on April 20th, is going to give investors a first look to see how Netflix is progressing to their positive cash flow goal by the end of this fiscal year. And over the past 3 months, analysts are only getting bullish on this next report and have raised their expectations 23 different times, and we're forecasting total revenue of $7.13 billion with earnings per share of $2.98. But over the past 4 quarters, Netflix has actually missed earnings per share guidance each and every time, but going forward throughout 2021, we're forecasting some major growth of 90% year over year over this next report, followed by 68%, 43%, and 52% over the next 4 quarters. And if we take a look at the company's income statement, every single year, Netflix has done a terrific job of growing their total revenue from only $8.8 billion back in 2016 to close to $25 billion over the trailing 12 months, and we can see a continuous exponential growth in their total sales, which has no signs of slowing down anytime soon. And if we take a look at their bottom line or the net income, it follows an even similar trend, generating over $2.7 billion of profits over the past 12 months. So definitely a company to take a look at in the streaming sector if you believe Netflix can continue to grow and it will be worth more than $242 billion over the next 5-10 years. This earnings report may be a great time to start a position in a company that's projecting to be cash flow positive by year end 2021. And now we're going to move on to the 6th and final company we're going over in this episode, and that is ticker NEE, which is Nextera Energy. They currently trade for $81 per share, and they are up by 36% over the trailing 12 months. This is an energy/utility company that has a market cap at $158 billion and a current yield of 1.9%. And this brand operates in more than one sector. They own FPL, which is the largest electric utility in the United States, as well as Nextera Energy Resources, which is the largest and the leader in electricity generated from the wind and the sun. So this is a company I own in my personal portfolio as well, and I like them for the exposure to the traditional sector as well as the growing renewable sector, which they are expecting more than 15% annual expansion over the next decade. And this company shares their latest earnings before market open on April 21st. We have a revenue estimate of $4.9 billion and earnings per share of 58 cents. And over the past 4 quarters, they have beaten on guidance every single time. We're projecting a slight decline over this next report, followed by some nice growth to close out the 2021 fiscal year. And we can see that Nextera has been one of the strongest performing utility companies on the market over the past 15 years. They're averaging annual earnings per share growth of 8.7%, and their total dividend is growing at an average of 9.6% every single year, which is extremely impressive. And over the past decade, they have returned a total of 700% to their shareholders versus the S&P 500, which has only returned 267% over that same timeline. And if we take a look at that fast-growing dividend, they currently yield just below 2%. They pay out a very sustainable 61% of their net income, and they've been growing that payment, averaging 12.5% over the past 5 years. So every single year, your 2% dividend may be kind of low at the beginning. It's compounding and growing at a very fast rate. This is a dividend aristocrat, and the company offers their shareholders a lot of long-term total share price appreciation of 175% over the past 5 years, which is absolutely incredible for a utility/energy company. And going forward, they expect to grow their annual dividend by at least 10% annually over the next 2 years. So definitely a company worth taking a look at for your own portfolios over the upcoming week. Nextera gives you exposure to the traditional and the fast-growing renewable space. They offer a very nice growing dividend, and this is a strong dividend aristocrat. I own them in my own portfolio, and I've been buying more over the past few weeks. So now we're going to wrap up the video. I want to thank you for watching to the end. Of course, we do this series every single Sunday, going over all the upcoming events for the next week to give you an idea of what companies may be impacted and what names to keep your eye on over the next few days. And of course, now that earnings season is back in full swing, we started off with last week with all the major banks who absolutely crushed it and posted massive revenue and earnings beats. And now this week, we have some consumer giants like CocaCola, we have some different telecom like Verizon and AT&T, some healthcare players, some utilities, and a wide mix of some very strong dividend-paying companies sharing their latest earnings over the next few days. So I'm expecting a very volatile week in the market. I'm expecting a lot of beats and misses, and really looking forward to getting some solid companies on any dips we see over the upcoming week. So thank you for watching to the end, and I will see you in tomorrow's video.